Your spouse just picked up a part-time job. Maybe it's 20 hours a week at a local school, a consulting gig, something flexible. And your first instinct is probably relief, right? Assist to a little extra income, maybe some breathing room. But here's what almost nobody thinks about in that moment. The spousal IRA you've been funding for years just changed. The rules shifted. And depending on how you handle the next few months, you either capture a significant advantage or you quietly lose contribution space you can't get back. According to the IRS, for 2026, the IRA contribution limit is $7,500 per person. And if you're 50 or older, there's an additional $1,100 catch-up on top of that. That's $8,600 per person per year sitting on the table. What I want to walk you through today is exactly what changes and what doesn't when your spouse goes from zero earned income to something, and why getting that answer wrong in your mid-50s costs more than you'd expect. So let me back up and explain how the spousal IRA works in the first place, because I find that even people who've been using one for years don't fully understand what's holding it together legally. The IRS generally requires that an IRA contribution be funded by earned income, wages, self-employment income, things like that. If you don't have earned income, you can't contribute to an IRA. That's the base rule under Section 219 of the Internal Revenue Code. The spousal IRA is the exception. It exists specifically for a married couple filing jointly where one spouse has little or no earned income. As long as the working spouse earns enough to cover both contributions, the non-working spouse can fund their own IRA up to the full limit. So if you're 55 and your spouse hasn't worked in 10 years, you could have been funding 2 IRAs, yours and theirs, using your income alone. That's entirely legal. And honestly, it's one of the most underused retirement tools I've seen families skip past because they assumed you each had to earn your own way in. The number that matters here, your combined IRA contributions, can't exceed your combined earned income for the year. If you're both over 50, the max is $8,600 each, so $17,200 total. Your household just needs to have at least $17,200 in earned income between you to unlock both of those fully. For most working households, that threshold isn't the constraint. The constraint is usually cash flow or awareness. People just don't know they can do it. Now, here's where the part-time job changes the math in a way that's actually good, though it introduces one complication worth knowing about. When your spouse has their own earned income, even $15,000 from a part-time position, they are no longer contributing to an IRA under the spousal rules. They're contributing as an individual with earned income. That distinction sounds bureaucratic, but it matters for one specific reason. The contribution limit doesn't change, but the income your household can point to, as the funding source does. You now have 2 separate income streams, which means the IRS's can't contribute more than you earned ceiling becomes much easier to clear. If your spouse earns $20,000 part-time and you earn $60,000, your combined earned income is $80,000, well above the $17,200 you'd need to max out both IRAs at the over 50 catch-up level. My take is this, the part-time job doesn't create a problem for your IRA contributions. It removes one. The question shifts from, do we have enough earned income to fund both IRAs, to which type of IRA should each of us be using now that our income picture looks different? That question matters because your spouse's new income could affect the Roth IRA income phase-out thresholds, and that's where I'd want you to pay close attention. For 2026, if you're married filing jointly, the Roth IRA contribution starts phasing out at $236,000 of modified adjusted gross income, and it's completely phased out at $246,000. Those are the IRS figures confirmed for 2026. If your household income was comfortably below $236,000 before your spouse went back to work, a part-time income of $20,000 or $30,000 probably doesn't push you anywhere near that ceiling. You're fine. Keep contributing to the Roth, but, and this is less common, but real, if you were already close to that $236,000 threshold on your income alone, your spouse's new W-2 could be what tips you into the phase-out range. I've seen this happen with one higher-earning spouse and a partner who picks up contract work. It's worth running the numbers before the end of the year, not in April. The IRS doesn't care that you didn't realize. They'll simply disallow the Roth contribution, and you'll owe a 6% excise tax on the excess For every year it sits there uncorrected under Section 4973. If you do end up over the Roth limit, a traditional IRA deductible contribution might not be available either, depending on whether you have access to a workplace retirement plan. This is the spot where individual variation really does change the answer. Your filing status, your access to a 401k or 403b, and your modified AGI all interact. But the right default move if you're bumping into the Roth ceiling is to look at a backdoor Roth conversion before you do anything else. That's a separate strategy. But the door doesn't close just because your income went up. I research retirement strategy for a living, and the thing that still gets me is how often families just stop funding the spousal IRA the moment the non-working spouse picks up income, as if the old rule disqualified them rather than changed. It doesn't disqualify them. It just means the justification for contributing shifts from the spousal exception to ordinary earned income eligibility. The account still works. The limit is the same. Nothing breaks. What does change, and this is worth writing down, is that your spouse's new IRA contributions must be funded from income that exists in the same tax year. IRAs allow you to contribute up to the tax filing deadline, including extensions, but the earned income that backs the contribution has to have been earned in that calendar year. So if your spouse starts working in October 2026 and earns $8,000 by December 31st, they can contribute up to $8,000 to their IRA for 2026, not the full $8,600 catch-up, because their earned income caps it, not the IRS limit. Small distinction, but it trips people up. Now let me talk about sequencing, because this is where I think the real opportunity is for someone in their mid-50s who's been behind on retirement savings and just got a second income stream to work with. If both you and your spouse are 50 or older in 2026, you're each eligible for the $7,500 base IRA limit plus the $1,100 catch-up, $8,600 each. If your spouse also has access to a workplace 401k through their new part-time position, things get more interesting. The 401k employee deferral limit for 2026 is $24,500 with an additional $8,000 catch-up for those 50 and older. That's $32,500 in 401k space for a single person over 50. Not every part-time job offers a 401k, and not every plan allows part-time workers to participate immediately. The Secure 2.0 Act changed the rules so that long-term part-time workers who log at least 500 hours per year for 2 consecutive years must be allowed to participate, but a brand new part-time hire may have a waiting period. Worth asking the HR department directly in the first month. Here's how I'd sequence this if I were sitting across from you. First, fund both IRAs to the maximum, $8,600 each if you're both over 50. That's $17,200 total, and it's the simplest, most flexible retirement contribution you have because you control the investments and there are no employer plan strings attached. Second, if your spouse's new employer offers a 401k and they're eligible, contribute at least enough to capture any employer match. That match is a 100% instant return, and I've never seen a reason to turn it down. Third, if you have a high-deductible health plan, don't overlook the HSA. The 2026 family HSA limit is $8,750, plus a $1,000 catch-up if you're 55 or older. That money goes in pre-tax, grows tax-free, and comes out tax-free for qualified medical expenses. It's the only triple tax-advantaged account most families have access to. After those three, then we can talk about taxable brokerage accounts or additional 401k contributions above the match. That ordering isn't random. It reflects where you get the most tax efficiency per dollar at this stage of the game. Fees matter too. I'd be remiss not to mention that a 401k with high expense ratios can quietly erode gains that would have been better off in a low-cost IRA at Vanguard or Fidelity. Look at the plan's fund options before you contribute beyond the match. The bottom line is that a spouse returning to part-time work in 2026 is almost always a net positive for your retirement math. It adds earned income. It solidifies both spouses' individual IRA eligibility, and if there's a workplace plan involved, it opens up additional contribution space that wasn't there before. The only real traps are the Roth income phase-out, if your combined income rises into that $236,000 range, and the timing rule on matching earned income to contributions within the same calendar year. Both are avoidable if you check the numbers before December 31st, not after. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this channel has been useful to you, subscribing is the best way to make sure you don't miss what's coming next. And if there's a specific IRA question, a Social Security timing question, or a tax situation you'd like me to dig into, drop it in the comments. I read them, and I work the good ones into upcoming videos. Next week, I'm getting into the 2026 Social Security wage base ceiling. It jumped to $184,500 this year. And what that actually means if you're a late career higher earner who's still working and trying to maximize your eventual benefit. That one's worth sticking around for.